To build anything that truly lasts, it takes time.
Take a look at an earnings candidate, Shriram Finance, in focus on the back of mixed set of numbers coming in. While all looks good, you have slight compression coming in on NIMs and a miss versus our estimates. But let's also focus on the positive and get into conversation with Mr. Y S Chakravarti, the MD and CEO of Shriram Finance. And Mr. Chakravarti, thanks so much for your time on ET Now today. Help us understand some segmental moves that we've seen from your earnings this time around, because at a time when your entire industry is saying that there is stress in the CV and MSME space, your growth in this segment has been good. You've also highlighted that there is no stress in these segments. Help us understand what's working for you that's not working for the rest of the industry.
Morning. Probably on the MSME side, see, majority of our portfolio, we have do not have much of an exposure to manufacturing, but a majority of it is towards services and trading. So there is not much. We've not seen much of a stress in these two segments. As far as vehicle portfolio is concerned, if you look at it, probably I wouldn't say there is a zero stress, because if you, there is a movement from stage 1 to stage 2, but which is actually in the segment that we service, particularly the used vehicle market. The movement between stage 1, stage 2 keeps happening, and that's the reason why we said we are not really worried about the movement there. It's quite common. We have been seeing it for quite a few years, that the the movement between stage 1 and 2 keeps happening, and then it keep pulling it back.
Mr. Chakravarti, this is Shrishti also joining in. But if we look at your internals, then after a long time, the new CV segment has outpaced the old. Help us understand the phenomena. Is it the new CV segment which has picked up, or has the used CV segment slowed down more than the new?
It's actually the new CV segment picking up, because see, we are predominantly a used CV player, but our customers, a lot of our customers have started upgrading their vehicles. So it's the result of that is the new CV picking up. And also, some of it also is due to our construction equipment. Last couple of quarters, 3 quarters, are again, same thing, our customers, we have acquired some new customers, existing customers upgrading.
Chakravarti, good morning. Mansi this side, and let's now talk about the absolute numbers and the margins trajectory. On a quarter-on-quarter basis, the numbers and the percentage-wise, it remained intact. While we were expecting NIMs improvement coming this quarter due to normalization of access liquidity, but that has not happened. What has been the reason for decline in the margins, and the company has the company given guidance of 8.5% NIM for FY26? What will drive the margins going ahead?
See, fundamentally, we were not able to, honestly, the liquidity is one issue. Definitely, excess liquidity has played a negative impact. The other reason is also the quarter has been unusually good for our deposit mobilization. It's almost doubled during the quarter, probably due to the falling rate scenario. I think the deposits have grown much higher than we anticipated. And the other point is, again, on your our guidance for NIMs, we still stand by that 8.5% of NIMs. One is we will be utilizing the liquidity in the next 2 quarters, reducing it by a large margin. And also the incremental borrowings are coming at a much lower rate. I think these two will aid us in delivering the guided number.
Was exactly my next question, Mr. Chakravarti, because when we see your numbers, you do have an excess liquidity of 9,000 to 10,000 crores. Now, given the low credit growth cycle, till when do you expect this to reduce the excess liquidity, and what will be your strategy to deploy this money?
See, maximum 2 quarters. One. Second is we have also slowed down our borrowing program. So we are sure that we should be back at our normal levels of liquidity of about 20,000 crores in the next 2 quarters.
We really hope and wish that you meet the goals that you're strategizing on that front. But moving ahead and talking about the forward-looking approach, in your commentary, your company has said that the operating expenditure will remain elevated till Q2 of FY26. Now, what will lead to these elevated levels, if I may ask?
No, the first quarter was primarily because of the staff costs going up, our increments adding to the expenses, and some infrastructure expenses where we had to spend some money on upgrading the infrastructure in branches for gold loans. So I think it should become normal. We should bring, which is at 29.29 now. It should come down to about 29 next quarter, and then next 2 quarters we should bring it down. We will bring it down.
Looking forward to that. But Mr. Chakravarti, specifically on the gold loan book, if we see then for this quarter, there has been a 19% decline. If you can help us explain that what led to that, and going ahead, what's your plan to increase the whole gold loan book size, given the fact there's a lot of competition that is trickling in, not just from the gold financiers, but even the other banks and the financial names are looking at this particular portfolio quite much at this point in time?
See, it's a pull. Gold is basically a pull product, and a lot of our, even our internal customers are not aware that we do gold. So we were actually working on that for the last 3 months. In fact, the disbursements in the last 3 quarters has been steadily increasing. You will see the incremental effect of that book in this quarter, in the second quarter. We will. The idea here is to double this book in the next 3 years, and I'm sure we will be able to do it with the increase in the network also.
Last thing, Mr. Chakravarti, your incremental cost of funds are already down by 50 basis points on a quarter-on-quarter basis, and the company has said that it will more on securitization and capital markets for funding. How much will this reduce your cost of funds going forward?
See, currently it is at 8.37. So the incremental borrowing is at 8.37. I think we will be probably next 2 quarters, we expect to hit anywhere between 8.1, 8 to 8.1.
All right, we'll watch out for that. But with this, we let you go on that, Mr. Chakravarti. Thank you so much for taking the time out and speaking with us. Always a pleasure.
Thank you.
All right. So